The 2026 recession is not a distant threat. It is a current trajectory shaped by slowing global growth, persistent inflation pressure, and tightening financial conditions. The International Monetary Fund has cut its 2026 global growth outlook, citing geopolitical tensions and supply chain disruptions that raise the risk of a sharper downturn. Smart investors do not wait for official recession declarations to act. They position their portfolios before market volatility spikes, before asset prices correct, and before mainstream narratives shift from growth to survival. This guide breaks down exactly what they do now, not later. First, prioritize liquidity buffers. Cash is not just a safe asset in recessions, it is your most powerful tool for opportunity. Smart investors hold enough liquid capital to cover 6 to 12 months of living expenses and ongoing investment obligations. This buffer eliminates the need to sell assets at depressed prices during market panics. It also lets you deploy capital when high-quality assets become undervalued. Keep this liquidity in short-term, highly instruments like treasury bills or money market funds, not long-term bonds or illiquid assets. Liquidity without accessibility is useless in a crisis. Next, rebalance your portfolio for resilience, not returns. The traditional 60-40 stock-bond split no longer works in today's volatile environment. Smart investors adopt a modified framework that includes alternative assets to reduce correlation across holdings. Equities focus on quality, not speculation. Target companies with strong balance sheets, consistent cash flow generation, and pricing power. Businesses that can maintain margins even when consumer spending slows. Avoid highly leveraged firms, unprofitable growth stocks, and companies dependent on excessive borrowing. These assets collapse first in recessions. Fixed income requires equal caution. Extend duration only if inflation expectations fall, but keep most bond exposure in high credit quality short and intermediate term securities. Government bonds from stable economies act as effective hedges against stock market declines. Corporate bonds demand strict credit analysis. Stick to investment-grade issuers with low debt-to-equity ratios and predictable revenue streams. Junk bonds offer tempting yields but carry extreme default risk when economic conditions deteriorate. Alternative assets form the third pillar of a recession-resistant portfolio. Gold is non-negotiable. It has preserved value through every modern recession, acting as a hedge against currency devaluation and market fear. Allocate a meaningful portion of your portfolio to physical gold or gold ETFs, not as a speculative trade but as long-term insurance. Real estate requires selectivity. Focus on income-generating properties in resilient sectors like residential housing or industrial logistics. Avoid commercial real estate tied to struggling retail or office markets. Private credit can offer attractive risk-adjusted returns but only through established funds with proven track records of navigating downturns. Debt management is non-negotiable for smart investors. High-interest debt, credit cards, personal loans, variable rate mortgages becomes crippling in recessions. Smart investors eliminate this debt before a recession hits, freeing up cash flow and reducing financial vulnerability. Fixed rate, low-cost debt on income-generating assets can be manageable, but leverage must stay conservative. Recessions amplify financial risk. Excessive leverage turns temporary downturns into permanent losses. Sector selection separates winners from losers in recessions. Defensive sectors outperform cyclical ones consistently. Consumer staples companies selling food, household products, and essential goods maintain demand regardless of economic conditions. Healthcare follows a similar pattern. People prioritize medical needs even when budgets tighten. Utilities offer stability through regulated revenue streams and essential service demand. Cyclical sectors like luxury goods, travel, and construction face severe revenue declines. Technology requires differentiation. Avoid unprofitable tech firms, but hold on to established tech companies with strong cash flow and enterprise-critical products. Risk management extends beyond asset allocation. Smart investors avoid over-concentration in any single asset, sector, or region. Diversification is the only free lunch in investing, reducing volatility without sacrificing long-term returns. They also avoid timing the market. Attempting to predict exact market tops and bottoms leads to missed opportunities and increased costs. Instead, they use dollar-cost averaging to deploy capital systematically. reducing the impact of short-term volatility. Behavioral discipline matters as much as strategy. Recessions trigger fear and panic, leading investors to sell at the worst possible time. Smart investors stay disciplined, adhering to their predefined investment plans. They view market declines as opportunities to buy high-quality assets at discounts, not reasons to exit the market. They ignore mainstream media hype and social media noise, focusing instead on fundamental data and long-term value. Now is the time to execute, not plan. Waiting for clearer signals means acting too late. Markets price in recession risks months before official declarations. By the time a recession is headline news, most assets have already corrected. Smart investors build liquidity buffers, rebalance portfolios, eliminate high-interest debt, and select defensive sectors now. They position for stability in the near term and opportunity in the recovery. Recessions do not destroy wealth, they redistribute it to those prepared to act before the crowd. The difference between successful investors and everyone else is timing. You can wait for the recession to arrive, then react in panic.